Thank you for that introduction, Lynn. My name is Peter Fugaro, as Lynn has mentioned. I manage a technology and marketing consulting firm in Greensboro, North Carolina. And as Lynn mentioned, we are exclusively working one vertical market, that's financial services. Our customers are banks, mortgage companies, credit unions, housing agencies, and service providers in the financial services space. So we understand your business, and obviously we understand marketing and technology. We're going to go over, use the clicker here, we'll go over the agenda real quick. One of the marketing 101 things you learn early on is really to understand before you start marketing and doing business development, what is the market? And I'm going to take you through some statistics. I used to be an economics major, so I'm kind of a numbers geek. Take you through kind of the state of the union of credit unions, banking, and the financial services in this current economic times. I'm going to take you through that. And then Jeremy and I are going to take you through some specific business development and marketing tactics. And then Jeremy's going to talk about cloud marketing, and I'll let him get into more details on that. So we're going to take you through some market conditions and then through some specific marketing and business development strategies that you can bring back to your credit union and hopefully grow your membership, or at least grow the business within your membership currently. I thought, as Lynn mentioned, I thought Phil's presentation was fantastic. As a CEO, one of the things I will just kind of reiterate something he said: positive return on investment. Everything that we talked to you about today can be measured and should be measured for positive return on investment. To steal a word he used, even though I'm a technology geek also, I'm not into cool things just for the sake of getting cool things. I'm not going to buy my team all iPad 3s unless there's a specific reason, positive return. And positive return on investment could be either measurable in financial growth, either return on, as we talked about, growth in earnings or growth in revenue, but it also may be soft, like in terms of member satisfaction. As a nonprofit group, it's obviously important to have member satisfaction. So even if there's not a monetary gain, you should be able to measure positive return on investment in satisfaction of your members. And you can, and we're not going to spend too much more time on this, but you can measure return on investment even on those pens and on those coffee mugs. And we can talk about afterwards. You can ask me some specifics on how you do that. So again, everything Bill said regarding positive return on investment, keep in the back of your mind as you're going through our presentation. Okay. As mentioned, very important to go over market conditions. I'm going to take you through some numbers, talk about kind of the state of our economy. Again, I'm an economics guy, so some of this hopefully is of interest to you as it is to me. Just to talk a little bit about comparing and contrasting credit unions and banks. There's about 7,300 credit unions in the country. That number changes depending on which group or organization you're looking at in terms of giving you numbers. There's about 6,500 federally insured banks in the United States, so there's actually more credit unions than there are banks. Obviously, there's bigger banks, and we're going to get into that in a moment. But if you take a look at the failures, 2009, 2010 were pretty bad years for banks in terms of failures. That's the number of failures that happened through those years and into 2011. We developed these slides back in December, so some of these numbers are slightly outdated, although nothing really majorly changed in terms of that. If you compare that, there's just as many credit unions as there are banks, yet there was about 10%, little 15% of the number of credit unions actually failed. So credit unions have fared better in this downturn market than banks have in general. We'll talk about some of the reasons of why that is, and I think you guys know why that is. But this is an interesting statistic that I'm going to come back to. Credit unions hold less than 7% of household finance needs. So you're only servicing 7% of the financial services transactions that are happening in the country today. And I want to keep that in the back of your mind when we come back and talk about growth and business development. When you take a look at size, credit unions have under $1 trillion. If you take every credit union in the United States, there's less than $1 trillion in total assets. If you take all the banks, it's over 12 trillion. So obviously the banking sector dwarfs the credit union sector in terms of size and market penetration. We'll talk a little bit more about that. And feel free to ask questions on any of these numbers or slides as I'm flipping through.
I have a question. So when you talk about bank failures versus credit union failures, is there more of an appetite in the credit union world to merge credit unions than in the banking world? Because I know that probably our mergers are much higher than banks would be.
Well, a lot of the bank failures were due to the fact that I think one of the biggest reasons why you see contrast in those numbers is probably the subprime mortgage lending. Most of those banks that went under had deep roots into what they call subprime mortgage lending tactics. So a lot of the failures, Washington Mutual, give you some big names, Countrywide, Wachovia, which did get merged into Wells Fargo, were due to bad lending practices that credit unions don't get into. In terms of mergers, I do think there's a lot of bank mergers going on as well, a lot of community banks merging together to grow market share. But I do think the single biggest reason is mortgage lending. I want to talk a lot about mortgage lending to go through that, but that's an excellent question. Another interesting statistic here, there's actually, JP Morgan Chase has $1.9 trillion in assets. And that's a little over $800 billion in deposits. Bank of America has over $1 trillion in deposits. Now, that is more, as you saw on the previous slide, $800 billion in assets for credit unions. These two individual entities have twice as much assets than every single credit union in the United States. To me, that's a startling statistic. Because we're talking about too big to fail. If anybody saw the movie, read the book, Too Big to Fail, we talk about the banking crisis and kind of the meltdown of the mortgage market. Yet these banks are getting bigger and bigger and bigger. Question?
When I see numbers like this thrown around, though, the bank numbers are obviously inflated by corporate assets, which we, quite frankly, are not really in a position to really go after some of that large corporate money. So is there a way to take the large corporate money that's in those numbers out so we have a better feel of what market share
and there is. And afterwards I can give you the website where I got it. I don't have it off the top of my head, but I can give you the website where I got a lot of these numbers. They do break it down. And you're right, those numbers look a little bit inflated due to the fact that there is a lot of corporate business in America. But it's still, so probably just the key thing, again, to point out is that you're still only doing 7% of household transactions, not corporate transactions, but 7% of household transactions. And the second thing is that these banks are getting bigger and bigger. And we're trying to do this too big to fail. Again, the Treasury Department and the Congress is trying to limit growth of these banks, yet they're getting bigger. And I think that's the point here. But I'll try to get you some numbers that are a little bit more equate to consumer deposits at both entities. You still see an inequity, but obviously not to the extent here. Whether your political views regarding the whole Occupy movement, I don't know what that is, and I'm going to try not to get too political here. But regardless, the Occupy Wall Street movement has been a good thing for credit unions. They had in October a big bank transfer day, where I think 250,000 new members went to credit unions and left the big banks. So hopefully, since this whole too big to fail and trying to put out the big banks, big corporate America, big Wall Street's bad, Wall Street banks are bad, that you as credit unions and and the community banks in the world should be doing better in this market. Yet 7%, it hasn't grown. It just hasn't grown yet in terms of household finance, even though people prefer to do business with the credit unions according to surveys. But you did increase. According to CUNA, there was 650,000 new members in 2011, so that's good. And that was, again, a lot of people left the banks when Bank of America and some of the other banks started really nickel and diming with fees. Is there a question?
That translate in amount of money that credit unions require?
In terms of getting new members?
Right.
Yeah, I don't have the numbers in terms of what, and I think Bill brought up a good point, is being able to measure what each member brings to the plate. If you're trying to get $100 profit like he was per member, I mean, that's 650 times $65 million in terms of bringing business in. So, yeah, and that's a good point. Bringing new members is one thing. Actually growing their market, growing services within that membership is very important.
I just read some CUNA statistics that it wasn't very much. And actually it's very disappointing is that we might be getting what they did want. So.
Yeah, and then Bill brought up a good point, is that if they're just cherry picking your services out and going to the big banks, and I want to talk a little bit about some of the services that you should be getting from your members to make money. So you're right, if they're just coming to get the good savings rate, drop the money in there, but they're going to get their auto loans and their mortgage loans at the bank, that's not helping you guys. And I think Bill made a good point about that. Last point again is just consumer index for credit unions is at the highest ever. So again, it should be a good time to grow credit unions because people seem to be fed up with the banks. And again, that Occupy movement is one of those things that, again, regardless of what your political view of the Occupy movement is generally friendly to credit unions. A lot of my expertise is in mortgage banking. A lot of the consulting that we do is helping grow technology and marketing at lending organizations, credit unions that do mortgage banking. So I want to talk a little bit about mortgage banking since that is obviously the biggest transaction that any one of your members is ever going to make in their life. Just in terms of the future, the Federal Reserve plans on keeping rates at extremely low levels so that it should be low interest rate, low mortgage rates for the foreseeable future. I know the rates, my dad bought his first house in 1968. I know my interest rate is lower than his was in 1968. So, and the Fed plans on keeping rates low. So again, this should be good for consumers as the real estate market hopefully picks up. The Mortgage Bankers Association, association that we're active members of, they're good at forecasting these kind of numbers for mortgages. They're estimating that there's going to be about a little less than $1 trillion in mortgages made in 2012 and growing a little bit more than that in 2013. To compare that though, in 2007, 2006, it was a $2.5 trillion a year industry. So this industry, mortgage banking, has dropped considerably. But still, $1 trillion in business is a lot of business, and again, a place where credit unions can capitalize. And again, hopefully a growth market. Despite the fact that volumes are down at mortgage banks and banks and credit unions across the country regarding mortgage loans, it is still profitable to make a mortgage loan. So when you talk about services, again, you don't want just the members dropping off their CD deposit. You want them getting loans from you. And a mortgage loan, according to statistics, third quarter of 2011, each mortgage loan we made about $1,200, a little bit over that. And then lenders that sold loans on the secondary market to Fannie Mae, Freddie Mac, Ginnie Mae, some of the other investors that are in the mortgage market make about $4,500 in income when they sell those loans. How many people work at a credit union that, or part of a credit union that offers mortgage loans, direct mortgage loans? Great, just about everybody. How many actually sell loans on the secondary market? Okay, these statistics match perfectly, about half. So again, keep that in mind as I'm going through this. Selling loans in the secondary market brings the capital back into your credit union, and you can be profitable with that by making about $4,500 and get your capital back into your organization. So keep that in mind when you're thinking about mortgage lending strategy. It's hard to say whether we're at the bottom of this housing crisis. This is a city, if you drive, I mean, you walk up and down the strip of Las Vegas, it's a beautiful sight. You drive around the communities outside of Las Vegas, I mean, it's perilous. I mean, you just see for sale sign, for sale sign, for sale sign. So the housing market in the Las Vegas area, Arizona, California, Florida, the industrial Midwest is still very depressed. So depending on where your credit union is, keep that in mind. Are we at the bottom yet? If I knew that, I'd be rich, right? I'd be able to, buy up all these houses and make some money. But there is some positive news where housing starts are starting to pick up. So hopefully, we're pretty close to the bottom of the real estate bust and starting to pick up. So again, just encouraging you to keep thinking about your mortgage banking strategy. Again, real quick, I'll try to go over these. You guys only did about 3.3% of the mortgage loans in the United States. So again, a lot of growth, a lot of growth. That's potential. I know you were up 3.3%, but it's only 5% of the marketplace. So a lot of growth from mortgage loans. This room was perfect. About half credit unions sell their mortgage loans to secondary marketing investors. That's a place to make income. Consider that as a strategy for the other half of the people that didn't raise their hands. The rates are about the same because you're going off of indexes, whether you go to a credit union, a bank, or a mortgage company. But credit unions offer great deals on less fees and that sort of